Hi, folks. It is Monday, December 11th. I'm Sean Shelf, one of the founding partners of Reliant, and we had some trading that happened last Friday. I wanted to talk to you a little bit about that. So as some of you noticed in your accounts and have reached out to us about, TAPA had a trade on Friday. It's a pretty large trade, too. What has actually happened over the last several months, as you can see on this chart starts back in September 1. And back then, the market was falling, and it hit a bottom point here at about October 27th. From October 27th, though, you can notice it had a really strong bounce. Has been pretty much going up ever since. And since October 27th, the rise in the S&P 500 has been about 11.8%, which is a pretty good chunk. That rise over that time frame has then triggered a TAPA trade for us. So some of the trades were made back on Friday. The finishing up trades will happen today on Monday, and that's what's going on. Why I wanted to talk to you about it, though, because TAPA trades happen, is this trade's going to be a little different than just a normal trade. To understand that, what I want to do is, for some of you, go through the history of TAPA and talk about the different iterations that have happened in TAPA. The first iteration, when we first developed it, was back in 2014. Back then, we developed a primary trigger or formula that we used to determine, to signal us whether we should be all in growth or all in defensive. Or another way to put that, should we be, of the money that's in TAPA, should it all be in the market or out of the market? Now, the point of TAPA at all is to try to make, over time, good rates of return, but at the same time, try to control the sequence of return risk that we've talked to so many of you all about. Because as long as the U.S. isn't in recession, you pretty much want to be in growth assets. But if we're entering into or in recessions, growth is not the thing to be in. So that's what TAPA is kind of trying to do, is in times where the market's doing well, is be very heavy in it. And in times economically that normally the market would falter, is to try to protect from it. So that was the first iteration of TAPA. The second iteration of TAPA is we lowered the number of market indices we were following, because we realized we could get the exact same impact we were looking for by being more focused and not having to follow so many market indices and trading in all those indices. So the second iteration of TAPA is we really focused down on which indices we were following. The third iteration of TAPA happened several years ago, and that's where we added several secondary triggers on top of the primary trigger. And what these secondary triggers did is they allowed us to make partial trades. So no longer did we have to be all in or all out. Depending on how the primary and secondary triggers lined up, we could decide to be partially in or partially out, depending on how strong we felt about what was going on. The trade on Friday now represents what will become the fourth iteration of TAPA. And in this iteration of TAPA, we're going to start using third-party managers through mutual funds or ETFs. Up to this point, we've been doing all the trading in-house ourselves, deciding when to trade and using our own formulas. With this iteration, we are going to introduce third-party managers who each have their own formulas, different ways to decide how much to move into growth or defensive. They all work slightly differently, which is why we'll have more than one. But because of how they all work together, we also feel we can lower the average allocation of the amount of money that we have in the TAPA layer. Looking at how the managers work together, we think we can take down a bit of the amount of money that's in TAPA to move into the, and we can move that into the other layers, and we'll still get the impact out of TAPA that we want. So there's a couple things that have happened that made this fourth iteration come along. For one, third-party managers now have a much longer track record than when we started this in 2014. We had looked at third-party managers in 2014 and weren't yet comfortable enough in watching how they did things and that they'd been doing it long enough. Well, now, not only can we see how some of the managers go all the way back to before the tech bubble burst of the early 2000s. So not only can we see how some of them would have done in 2000, how they would have done in 2008 during the Great Recession, how they would have done during the first kind of U.S. credit downgrade event that happened in 2011, which kind of drove the markets crazy. But now we can also see how all those managers would have done during 2018, when the Fed and the president were getting in a fight, and it drove the markets crazy. We can see how they did in 2020 during the pandemic when the markets had its record fall as far as how fast it fell. We can see how they did during that. We can see how they did during 2022 when interest rates started to go up rapidly to try to deal with really high inflation. So we have really good track records on these managers now and can feel comfortable with how they work and how they would work together. Second thing that's kind of going on is right now it certainly feels like that markets both change directions faster than it had in the past. It feels like how often it goes from being on an upward trajectory to a downward and vice versa, a downward trajectory to upward. Those happen faster, it certainly feels like, than it had in the past. And on top of that, when it does change direction, the changes are larger in size as far as a percentage basis. What percent does it move up or down in any one day? Feels like it's a lot faster. And because of those two things, that it changed the directions faster and it's larger in size, we feel like these third-party managers are better equipped to move faster than we can just individually here. They're going to do a better job, I think, of being able to react as the market starts to change quicker and quicker and quicker. So there's two continues that I want to point out to you. One, TAPA, for those of you that have it, is going to continue to be an important layer in your portfolio. Again, the point of TAPA is to try to control sequence risk. We feel like this TAPA has done a very good job of doing that and will continue to do that. So it'll continue to be an important layer in the portfolio along with the other layers that are in the portfolio as well. And also, Reliant will continue to look for ways to improve this layer even further. We don't ever sit back and think things are good enough. We always are interested in asking the question, can this be better? Can we get better outcomes for clients? And we will continue to do that. And once we feel confident that we found a way to do it, we will. So hopefully this answers some of your questions, helps you understand some of the trading that occurred. I hope you have a great holiday season. I'll talk to you soon.